Welcome back to TalkTickers. Today, we are taking a deep dive into the Q2 2025 earnings call for SenesTech. That's ticker SNES.
Right. And this is a microcap name that saw some pretty wild swings around the results.
Yeah, a big pop right into the call, but then, well, quite a slide the day after.
And that really captures the whole story here, doesn't it? You've got this tension. On one hand, really high executions, especially on gross margins, great product mix shift.
With the EVIL VL solution, yeah.
Exactly. But on the other hand, the market's reaction, that slide, it shows, the skepticism about the heavy lift needed for real scale.
So that's our mission for this deep dive. Unpack those record revenue numbers, figure out why EVIL V is such a potential game changer for them.
Look at the balance sheet, too. It's much stronger now.
Right, and assess what management's saying about that path to cash flow break even. It seems clear, but maybe a bit distant.
Let's find out.
Okay, let's jump in with the headlines. The numbers, they look pretty solid, at least on the top line and product quality side.
Definitely. Total revenue hit $625 million.
Which is a record quarter for them. That's up 36% year over year and 29% just from the previous quarter.
Solid growth, yeah. But like you said, the quality of that growth is maybe the bigger story.
How so?
Well, the main driver wasn't just selling more stuff. It was the shift to their EVIL VE rodent fertility solution. That's their high-margin product.
Okay.
Its revenue jumped, get this, 94% compared to last year, and now it's, 83% of their total sales? Huge shift.
And that directly feeds into the margins, right? That margin triumph everyone was talking about.
Absolutely. Gross margin expanded dramatically, hit 65.4% for the quarter.
Wow, compared to 54.2% a year ago. That's let me do the math. Over 1,100 basis points.
Yeah, 1,120 basis points. It tells you the unit economics on EVIL V are really strong.
Okay, and there's always a but, especially with microcaps.
Yeah.
The bottom line tells a different story, doesn't it?
It does. That's where you see why the market might be hesitant. The adjusted EBITDA loss, narrowed a bit, but still -$1.4 million.
And net loss was monotonous $1.6 million. The GAAP EPS, earnings per share, that was a loss of 0.87 cents.
So yeah, they're burning cash to achieve that growth, which isn't unusual, but it's something investors watch closely.
And that leads us straight to the big target, the break-even point.
That's right, yeah.
Management kept mentioning it. They reiterated that cash flow break-even is achievable at around $1.5 million in quarterly revenue.
Right. $1.5 million.
Okay, hold on. They just reported $0.625 million. So they need to more than double, almost triple that revenue per quarter.
A big hurdle, a very big hurdle.
So where is that extra, roughly $900,000 in quarterly revenue supposed to come from? What's the plan there?
What's the million-dollar question, isn't it? Or maybe the $1.5 million question. They're banking heavily on operating leverage.
Meaning as revenue grows, costs grow much slower.
Exactly. And they laid out why they think margins will keep expanding. It all comes back to EVIL VE. Management literally called it a game changer.
Why is it such a game changer, fundamentally?
Well, it's non-lethal. It's fertility control for rodents. And that's increasingly important for places, especially cities, trying to move away from traditional poisons.
So it's differentiated, meets a specific need.
And commands a premium price because of it, hence the high margins. And operationally, they seem to be gearing up.
The new facility?
Yeah, the move to a new, larger facility down in Phoenix. It's got automated capabilities. That huge margin jump we saw, the 65.4%, that's likely tied to that automation kicking in, lowering their cost of goods.
Okay, so they're built for scale.
Seems like it.
Sure.
They mentioned current capacity is around $10 million in revenue per year. So they can make it, they just need the orders to ramp up significantly.
Which costs money. Ramping up sales, marketing, supporting those channels. How are they funding all this? Let's talk about the balance sheet. That seemed like a real positive.
It was a major positive. Definitely de-risked things quite a bit. They recently finished up a series of capital raises.
Right, using warrant exercises and their ATM facility.
Yeah, the at-the-market facility. It basically lets them sell shares incrementally into the market, which should be less disruptive than a big secondary offering.
And the result?
A pretty healthy war chest.
Yeah.
$11.2 million in cash as of early August.
That's huge for a company this size. And management was quite clear about what that means, weren't they?
They were. They explicitly said, this funding gives them an operating runway through the end of 2027 and beyond.
So that multi-year bridge, that removes a massive overhang, right? The fear they'll run out of cash before hitting profitability?
Exactly. Buys them time. It buys them patience to let these sales channels, especially the slower ones, develop.
And the share count. after all that
Yeah, just
activity.
manageable. Around 5.3 million shares outstanding now. So yeah, the takeaway is they have the cash to execute their plan.
Hmm.
Profitability might still be a ways off, but the immediate funding risk seems gone.
Okay, so they have the cash, they have the product, they have the capacity. Now, execution, that six-channel strategy they keep talking about. Which parts are actually working now?
Well, e-commerce is absolutely on fire.
Really?
Yeah, it's now over half their quarterly sales, 56% in Q2. Amazon's the big driver there, apparently growing 10% to 15% month over month.
Wow, okay. That's impressive growth. Almost like a subscription business feel.
Kind of provides a nice base, yeah.
Yeah.
Then you have the municipal and government channel. This is the one everyone sees as the big potential lottery ticket.
Because the orders could be huge and recurring.
Exactly. And sales there were up over 500% year over year, driven by new deployments, reorders in big cities, New York, Chicago, Baltimore, LA, even some Boston
They
suburbs.
gave an example in Chicago, didn't they?
They did. Chicago's Wicker Park, Bucktown Special Service Area, the SSA, they reported significantly reduced rat activity since SenesTech started there in April.
Okay, that's positive anecdotal evidence.
And the company said they're working to replicate that across Chicago's other SSAs. That's the key, right? Converting a successful trial into a bigger ongoing service contract. That's the annuity stream they want.
But, I mean, one park in Chicago, that's a long way from a citywide rollout, providing hundreds of thousands in quarterly revenue. How fast do these things really move? Government contracts can be slow.
And that's precisely the skepticism. You nailed it. You need to see proof that these pilots convert and convert relatively quickly into those big recurring orders needed to hit that $1.5 million target.
Okay, any other channels showing promise?
Well, retail and wholesale also had a huge jump, almost 500% sequentially. That was mostly due to a new deal they signed with a wholesaler, Bradley Caldwell. Reaches about 8,000 dealers, apparently.
Didn't they get listed on HomeDepot.com right after the call?
They did,
Mm-hmm.
which is good validation for getting into that big box space, even if it's just online for now.
So e-commerce strong, municipal promising, but needs proof, retail growing. What's lagging?
The ones that probably require the most patience, large-scale agriculture and traditional brick-and-mortar retail. Those trials, in almond orchards, sugarcane fields, they take a long time to prove efficacy and they convert into large, regular orders.
Right, long sales cycles. And that directly impacts how quickly they can ramp towards that $1.5 million quarterly number.
Exactly. It puts pressure on that timeline.
Okay, let's pivot a bit. Investor context. We saw the good stuff. 65% margins, $11 million in cash, 500% growth in some channels. Yet the stock pops, then fades hard, down nearly 13% the next day. What gives?
Yeah, why the big fade? It's sort of a perfect storm of micro-cap reality.
Okay.
First, just thin liquidity, not many shares trading hands. So if even a few larger holders decide to sell, it can move the price dramatically. There just aren't enough buyers waiting to soak it up instantly.
Standard microcap volatility.
Pretty much. But second, and probably more important here, was the lack of any formal forward revenue guidance.
The market hates uncertainty.
Hates it, especially when you set a specific break-even target like $1.5 million quarterly. Investors need to see the path. They want evidence quarter by quarter that the revenue is accelerating towards that number.
So the credibility really hangs on converting those pilots, making them predictable, recurring revenue streams.
That's it in a nutshell. They need to turn potential into actual large-scale annuity-like orders.
Management's sticking to that $1.5 million target, which is about a $6.5 million annual run rate? And they said the earliest flip to profitability would be second half of 2026.
Yeah, H2 2026.
Given what we just said about government slowness and long egg cycles, is 2026 realistic? Or is that maybe a bit optimistic?
It definitely feels ambitious, but they do have one really powerful factor on their side, that operating leverage we talked about.
Because it costs so little to expand production.
Incredibly little. They mentioned adding new manufacturing lines costs only like $300,000 to $400,000 for potentially millions in added revenue capacity.
Okay, that is significant leverage potential.
It means once the sales do start flowing at scale, profits could ramp up very, very quickly, which is why everyone's watching for near-term catalysts.
Right. So what should we be watching for specifically?
I'd say three main things. One, more municipal awards, especially seeing a pilot like in NYC or Chicago turn into a full-scale citywide deployment.
That would be huge, too.
Additional national retail listings. Getting into Tractor Supply, or maybe hearing news about those two largest home improvement chains they hinted at talking to.
Okay, and three.
International expansion. Getting regulatory clearance in places like Australia and New Zealand, that opened up whole new markets.
Got it. Okay, now we get to the part of the deep dive we call this is not financial advice.
Definitely not financial advice.
This is where we pitch a kind of outrageous but maybe plausible trade idea just for discussion based on what we heard.
Okay, so the trade idea today is basically a highly leveraged bet. A bet specifically on that municipal channel hitting an inflection point.
An inflection point meaning a big win.
A big win, exactly. Let's set it up. We know they have the cash runway now, right? Through 2027. That bridge is built.
Check. Financial risk minimized.
We know they have almost no capital expenditure needed to actually produce way more product.
Yep.
They can scale capacity for peanuts.
Check. Operating leverage potential is massive.
So the whole story boils down to execution risk.
Yeah.
Can they hit that $1.5 million quarterly revenue target before the runway ends, even though it's years away?
That's the core tension.
Right. So think about the municipal channel. Given the growth rates, even the anecdotal success, what happens if just one major city, let's just say New York City hypothetically, moves from its current trial phase to a full, continuous, citywide deployment?
That one contract could potentially fill a huge chunk of that gap to $1.5 million, couldn't it? Maybe even all of it, depending on the size.
It could happen rapidly. One big announcement. So the trade idea is long SNES, an aggressive position maybe with a relatively short horizon, say 3 months.
Betting on what specifically in those 3 months?
Betting that an unannounced large municipal reorder or expansion hits the newswires in Q3 or Q4, you're betting that single catalyst unlocks the market's perception of that operating leverage.
So you're saying the stock is priced now almost like the cash is the only real asset, ignoring the potential upside if they actually land a big fish.
Pretty much. It's priced for skepticism on execution. This trade exploits the asymmetry. The downside is sort of capped by the cash, arguably, while the upside from one big municipal win could be substantial, closing maybe, say, 75% of the valuation gap caused by the current losses as the market starts pricing in that $1.5 million normalized run rate.
Interesting. A very catalyst-driven idea, betting on one big domino to fall.
Highly speculative, hence the segment name, but plausible based on this setup.
Okay, let's wrap this deep dive up. We've seen SenesTech making really impressive strides operationally, driven by that high-margin Evolve product.
Yeah, the product mix shift is real. The gross margins are excellent. The balance sheet is finally solid. Takes away that immediate funding pressure.
And the strategy, that 6-channel approach, it's clearly working in places like e-commerce. Municipal pilots look promising too.
But the quality of revenue is great, yeah. But the quantity and the predictability are still question marks for the market. They need proof of scale, proof those big government and maybe agricultural contracts can land and become repeatable.
So the final thought, the question maybe you need to mull over is this. That strong balance sheet bought them time, years of it. But can management sell patience to Wall Street, especially in this market?
Is a runway through 2027 actually long enough when your break-even target is still almost triple your current revenue rate? Can they convert one or two of those big shots on goal? A major city, a big retailer fast enough to hit that critical $1.5 million inflection point before investor patience wears thin.
Something to think about. That concludes our deep dive into the SenesTech Q2 call.
Thanks for joining us on TalkTickers. We'll catch you on the next one.